Phil Walker is our guest, and like I said before, well, I did say quite a bit about him before, but I really can't say enough, so I'll shut up and I think I'll let him talk. But he's, like I said, this is must listening for anybody who is considering retirement, that is thinking about it in the far future, thinking about it in the near future, or if you are already retired. This is the place to listen. So go ahead, Phil, and tell us about you.
Well, I started out long ago back in the day as a financial advisor. I've worked for some of the biggest companies in the world, and left that industry about 12 years ago, and uh, saw a great deal of potential, a great deal of need for people to learn the right way to use reverse mortgages in financial planning. And the last 6 years, I've been very much involved on the research side. Matter of fact, I'm published. I've got a white paper that's on ResearchGate right now, as a matter of fact, and we're getting ready to release another one. And you know, what I see, and the reason I love doing shows like yours, Jay, is because this is undoubtedly, keep in mind, as a former financial advisor, I don't have any clients today, but I had to be versed in literally just about every financial tool product out there. And reverse mortgages quite literally are the most misunderstood product in the world.
Absolutely.
Undoubtedly.
I feel my number one job is education. I'm supposed to be doing loans also, but if you don't put education first, you'll get nowhere.
And well, I'll tell you what, I think this helps a lot because I've been training just thousands and thousands of financial advisors from coast to coast the last few years. I've spoken at most of the major financial planning national conferences for advisors and things like that. And what I found is helpful to understand is where the misconceptions come from. And where I've discovered they really reside is in the original reverse mortgage product of the 1960s, 70s, and 80s, long before FHA got involved in the product. And that was, first of all, that product's not even available today, right? It hasn't been available in a very long time, decades. And however, because it was called a reverse mortgage, people associate it to the product that we have today, which is completely unrelated. The product of the 60s, 70s, and 80s was a desperate product of last resort. It was designed with the intent of keeping seniors in their homes that were about to lose their homes. But once again, not only does that product not exist today, but people that are about to lose their homes generally can't qualify for today's reverse mortgage product. It's a financial planning tool today. And and Congress, when they instructed FHA to create their product, they laid out very specifically what it was designed for. As a matter of fact, I can pull up the exact words for you. I just happen to have them handy here. Well, I thought I had them handy here. Hang on. There we go. Okay, so this was Congress's instructions to FHA and HUD to meet the special needs of elderly homeowners by reducing the effects of the economic hardship caused by increasing costs of meeting health, housing, and subsistence needs at a time of reduced income through the insurance of home equity into liquid assets. In other words, they simply wanted to take what is for most people their largest asset and give it liquid features so they could utilize it in retirement instead of having to sell it to access that money. Right. So I want, if people are listening for the first time, they're just now investigating reverse mortgages, you have to understand that most of what you probably have heard is about a 3-decade-old product that doesn't even exist today.
And I wonder, this is a whole show in itself, so we shouldn't spend too much time on it. Why does the industry itself keep calling it a reverse mortgage?
That's a good point, right? Because the name of the product that FHA created doesn't even say reverse mortgage in
No.
it, right? It's the home equity conversion mortgage.
Because you're
And
converting it into an asset that you can grab. It makes your equity available. It doesn't mean you're taking it away or
right,
taking it
exactly.
out.
Exactly right. And the the problem is that it's human nature when you're introduced to something new to try and define it and put it in a box, right? And so when they created that product, people initially looked at it and saw that you didn't ever have to make a payment. You can make payments, of course,
Yeah.
but you never have to make a payment. My father had one for 9 years and never made a payment, absolutely loved it. And then they went, oh, well, then that must be a reverse mortgage. And it's just hung on ever since, right? And even people in the industry call it a reverse mortgage. So it's unfortunate because then all those misconceptions come along with it.
Yeah, it just brings baggage along.
Yeah, and I think probably the biggest takeaway that your listeners should hopefully get today out of our conversation is that this is probably the most rapidly today accepted product by the financial advisor community than anything else out there, right? Financial advisors.
It took a long time getting there, but that's where it belongs.
Exactly. And financial advisors are now getting trained on the product so that they can advise on the product.
Yeah, and I'm not going to mention any names because I work with all kinds of companies, especially the one you're somewhat connected to.
Right.
That's kind of number one. But anyway, one of these companies has somebody on television talking about you're going to run out of money. So many Americans are going to run out of money. Well, maybe some are. And it's wonderful to do one of these heckums for someone you can help. But that, like you just read from Congress, that is not why this was invented. And I think continuing to give out those kind of messages with some people's ads is probably not the best thing for the image.
Right. Well, those companies are trying to help people that have an immediate need. Right. And in the planning world, we look ahead and we go, okay, what can we do so we never get there? Right? What can we do now so that we don't have that immediate need? Okay. Great example is college planning, right? It is much easier to pay for college if you put an account together and you start sticking money away when the baby's born and still waiting until they're a senior in high school, right? And we take that same approach with a lot of things in the planning world. If we start dealing with long-term needs down the road today instead of later, like long-term care funding, right?
Boy.
If we deal with long-term care funding early in retirement instead of later, it's a lot easier to deal with.
The hardest thing for younger people, I think, is to spend so much money on long-term care when they feel healthy today.
Correct.
I mean, they have a hard time even paying for health insurance, even though they could have a car accident tomorrow and need it. But, as you get older and the long-term care becomes a bigger thing in your mind, the bell starts ringing louder. Of course, it gets much more expensive, and then it gets to a point where you cannot get it at all. So there's not a lot of people that have it, young, old, or whatever. There just isn't.
Right.
And I'm not sure, though, all the ins and outs and whether it can actually solve everybody's problems for that. But let's just say it's a great program, but almost nobody has it.
Yeah, well, a lot of time we spend a lot of time fighting human nature, right? And like you said, they wait until the aches and pains are happening or they starting getting concerned about being able to care for themselves, and then they try and do something about it, and often it's too late. Retirement planning is the same way. As a financial advisor, my clients that were in their late 50s, mid 50s, were very focused on executing their retirement plan because they were getting tired of working, right? They got the kids off to college, and now, boy, oh boy, they were just counting the days until they could retire. So they were focused on it at that time. But if they had focused on it in their 30s, man, it would have been easy. They'd be retired already.
Now all the money went to sending the kids to college, and
As I'm doing right
Not,
now,
not,
actually. Yes. Right.
As I said a couple times on the show, Cal State Fullerton, $700 a semester, not a unit, a semester. But I am part of the class of 1968, so
There you go.
You may not have been born yet.
Yeah. Yeah. Well, luckily, one of my sons just got a scholarship to play football for Cal Poly. So I've been given a break on one of them.
All right.
Hopefully the next one does it too. Thank you. So I think one of the things that you wanted to have me cover today was on this proactive idea
Absolutely.
of using a reverse mortgage early in retirement. And those of us in the research world are all in agreement that in the coming years, as we get more financial advisors trained on this, 62 will become your reverse mortgage birthday. Hopefully your Heckham birthday, right? Or
there you
your
go. We're starting a new trend
That's
here
right.
and now.
And the reason being is because if you can proactively use it early in retirement, you can make your portfolio last so much longer. And the first strategy I think people need to get acquainted with is called the coordinated withdrawal strategy. Now, this is from a study that was published in the Journal of Financial Planning. And what these doctors discovered, PhDs in the finance world, was that if you look at your portfolio performance on an annual basis, and at the end of each year, you just take a look and go, was it up or was it down? And if it was up, then take your next year's income from the portfolio again.
Right, that's what it's there for.
In those occasional years, which typically most people will only see this 4 or 5 times throughout their entire life in retirement, but in those occasional years that the market is down, more specifically their portfolio is down at the end of the year, then don't draw from the portfolio for a year, give that a rest, and instead take the next year's income from your line of credit
Absolutely.
on your reverse mortgage, whatever type that might be.
And I think I'm sorry, but
I was just going to say the outcome is if you do that consistently throughout retirement, the outcome is absolutely incredible.
Yeah, what I was just going to pop in case somebody was just listening casually. Fixing that 1 year isn't just a 1 year fix, because if you didn't fix it that year, every year after is going to be less than it would have been. So
that's exactly right. I equate it to whatever your portfolio is when you start retirement. Think of that as a brand new shiny retirement bicycle that you're going to ride. That's your vehicle that you're going to ride throughout retirement for income, right? And instead of riding that thing until the wheels fall off, get a bicycle pump. A $20 bicycle pump, right? So you can just pump it up every once in a while and make it through your entire retirement journey. And that's what this strategy literally does. All you're doing is you're leaving as much money in the portfolio as possible during the rebound, right? We've had markets for over 200 years in this country, and they always rebound. They have always rebounded for over 200 years, right? We went
markets always rebound, home values still go up. I mean, you can't guarantee it year by year, but overall, yeah, absolutely.
Right. 2008, we went through the Great Recession. The only thing worse that's happened was the Great Depression, and it rebounded once again. We are way beyond the highs prior to 2008. And so if you understand that it always rebounds and you only lose when you sell, right?
Yes.
You only lose when you sell. So if you understand that principle, then this strategy of taking your foot off the gas after a down market, leaving as much money in there to benefit from the rebound as possible, then it starts to make sense, right? But obviously, if you're not going to take income from your portfolio 1 year, you need the income from somewhere,
right?
And hopefully the cheapest source possible, and that's most easily from a cash flow basis going to be a reverse mortgage,
because it's tax deductible. It's non-taxable.
It's non-taxable.
And what you're actually taking it from is an asset that in most years will still be increasing.
Right, right. Usually over time, the appreciation on the home is equal or more than the interest you're accumulating.
Yeah.
Yeah.
And like this one guy once, this Phil Walker guy once told me that when you're in retirement, you actually are still employed. Your retirement itself is your business.
That's absolutely
that
right.
you have to keep track of and work on.
Yep, yep. You've been listening closely, haven't you?
Yeah, and you don't sell part of your business just to pay for something for tomorrow. You know.
Right. This is something that it's kind of funny. I developed over the years of doing all these webinars and trainings for financial advisors, and I said that one day, and the response I got was absolutely amazing. They went, some of them, wow, I've been a financial advisor for 20 years and I never really thought of it that way. As a matter of fact, I just was last week I was at TD Ameritrade's national conference in Florida, and I told that to probably 30, 40 different advisors, and they went, you know what, you're right. Right. And these are people that have been in the business for forever. But just to rephrase it, no, there are no retirees. Right? You may have retired from the career that got you to retirement. You may have left that career, but you really just changed careers. You went from whatever you did as a long-term job to being a professional investor. Now, the problem is you don't know how to be a professional investor, so you hired a manager to run that business for you. That's your financial advisor. Right. So that's the manager you've got. It's like I retired and I had a bunch of money and so I bought a McDonald's. I don't know how to run a McDonald's, so I hired a manager to run the McDonald's for me. Right. So you're hiring a manager to run your investment business. Right. And so now you are in the business of being a professional investor. And when you need to buy something as a business owner, you don't sell off part of the business to buy it. Right? That doesn't make sense. If I'm a restaurant owner and I need new kitchen equipment, I don't sell somebody part ownership in my company to buy that kitchen equipment, because now I just sold off the business's ability to give me income permanently.
Yeah, the future. You cut down your future.
Right. So it's the same thing with the portfolio. If you sell off part of the portfolio to buy something, you've permanently reduced that portfolio's ability to generate income. So just like the restaurant owner, instead of selling off the business, you finance what you need, right?
Yeah.
You either lease it or you take out a bank loan. In this case, professional investor retiree, you take out a reverse mortgage.
Right.
And wouldn't the business owner love to take out a business loan that didn't require any payments?
Yeah. And also, as that same guy once told me, if you are going to finance something, why finance it with the kitchen equipment company? You can finance it yourself and actually make the payments back to yourself.
Yep.
In the reverse, in the HECM, home or the conversion, whichever. And every penny you put in, whether it's principal or interest, increases the line of credit.
That's right. And that's beneficial. That's super beneficial, especially early in retirement. If you can, now again, my dad had one for 9 years and never made a payment and absolutely loved it. It gave him an extra, I think it was like $1,750 a month. He had every month to spend because he no longer had a payment. Right. But if you can make payments early in retirement, the benefit is that you've increased your available line of credit by paying some of it back. And it's that available line of credit that grows as you age. Right. This is the only product in the world that has a growing credit line that grows it. But you have, the bigger that line is, the more growth you get. And if people are wondering how that works, it's not tied to the appreciation of the property. It's its own calculation. It's the interest rate times the mortgage insurance rate, and it compounds monthly. So it grows pretty fast. And why that's important is because it gives you a tool to offset the number one thing that kills retirement plans long term, and that's compounding inflation, right?
Oh, yeah.
We love to joke about, and especially retirees love to joke about, oh my gosh, what was the price of gas or what was the price of milk 20 years ago, 40 years ago? And then they act like that's not still going to happen. Folks, there's going to come a day where we see $10 a gallon milk, right?
Unfortunately,
It's inevitable.
we don't see compounded inflation in salaries, though.
Right,
Unfortunately,
right.
so
Yeah,
you got to make sure you're covered.
that's exactly right. Yep, you
Be-
got it.
Yeah, because one thing, if you do have to spend your money to live on, instead of taking it for your portfolio, say 7 or 8, 9 years after you've retired or after you've taken the mortgage, the HECM, you're really using money that has increased since you took it. So
Yeah.
you're using money that in a way, it's a little more complicated there, but you're actually using money that you made because you had that reverse mortgage.
Exactly right. And I would encourage for those of you listening, if you have not heard about this strategy from your financial advisor, it's because he simply hasn't been introduced to it yet. And I would encourage you to ask your financial advisor to call Jay, and he can get them on one of our educational
Right.
webinars that specifically train financial advisors on how to do this and why to do this. And I can tell you, I've been doing this particular webinar for 2 years now. I have a 100% acceptance rate by all the advisors that see it. They absolutely love it.
And not to get into it too much, but you actually incentivize these financial advisors to do this because it's better for their clients, better for them.
Exactly right. You're probably working up with your financial advisor on a fee basis, and the more he grows your portfolio, the more money he makes too. And so there's a definite benefit for him. And if your financial advisor is a CFP, a certified financial planner, then they can actually get continuing education credits towards that certification. So they're going to win either way.
I think we're all winning by having you on the show today.
Oh, thank you.
I really appreciate it. Yeah, I was listening to a couple of I listened to all of the webinars as you put them out for whatever. And I know healthcare was another one, a newer one that you were concentrating on. Maybe we can do a whole show on that too.
Guaranteed.
Excuse me. But, we talked about how to protect your portfolio, your savings, whatever. But if you want to really protect, too, your legacy, I mean, the biggest challenge to that legacy is not a loan of any kind. It's healthcare, really.
Sure. And the problem, here's the greatest problem, and this is actually a problem facing our country and our federal deficit, which is already in trouble,
kidding, yeah.
Right? Is that 67% of every person that goes into a nursing home is paid for by Medicaid. Okay. Now, Medicaid doesn't have a big slush fund like Social Security. If you think Social Security is in trouble, take a look at Medicaid. It is way worse, right? Believe it or not, if we can just hang on long enough with Social Security, the millennials are going to come along and save us, right? Yeah. And the reason being, I know people are going, what?
I see what
could they possibly save us from? Their generation is almost as big as the baby boomer generation.
Yeah,
that's why they're called the echo. They're also called the echo boomers. And Social Security is paid for with. I know everyone thinks, God, I paid into it for years. Now I'm going to get that money back. Actually, no. Your money was spent on the people that were retired while you were working.
Yeah.
Your Social Security is going to come from the people that are working today. And so when they established Social Security, there were roughly 7 or 8 workers for every retiree. Now there's just 2. Ooh. Because Gen X is so small, right? And that's why Social Security is in trouble. But when the millennials come into middle management, upper management, or making more income, they will actually be contributing so much that it will fix Social Security. We just have to last until we get there. But Medicaid is the problem. And the reason it's a problem is because not only because it pays for most people in nursing homes, but 70% of our country falsely believe that their health insurance will pay for long-term nursing home care. And it doesn't. Right? It absolutely doesn't. And we could spend, like I said, an entire show talking about why, but understand that your medical insurance does not pay for nursing home care needs or assisted living for that matter. And so that's why you need to have a plan. And the earlier you put that plan together to deal with that. right? Now, the easiest way is just to take out an insurance policy. But then, what kind and how much, are a lot of questions to get with your financial advisor on.
Yeah, and long-term care, when you're our age, if you can qualify for a reverse mortgage, you may not be able to qualify for long-term care.
That's
right.
But
there are other products, and I can refer people to, because this is not my thing. I don't know, but I know there are certain products with healthcare riders and things like that, and
yes,
I don't know who qualifies and who doesn't, but I know older people have a chance at that, and here's one way to pay for it.
Exactly right.
So yeah, I really, it's really because, what happens when if you get sick without this long-term care, or even with it, because I don't really know how much it actually covers or will be able to. But you can, of course, you can borrow money from your kids, but let's say they give it to you, that's not too good for the kids because
Right.
you're worried about the kids. You could sell your house, and that just took care of what you were trying to save for them.
And that's actually what my first research study was about. It warned the wealth management industry about the fact that, they may have a client, a pre-retiree in their 50s, that just seems, like they're perfectly on track and everything's going well. But unless that financial advisor takes a real good look at that client's aging parents, and not only their retirement plan, but their plan specifically around funding their long-term care needs, then all of a sudden that client that seems perfectly on
and
track,
that's something most of us
can
don't
end up
even
having to
think
work
of
another
that.
10 years.
Yeah.
Helping a parent with a 6-figure annual expense.
Because you do want to hear your parents. And by the way, I get very little pushback from children. I know it seems like maybe we should, but we don't. We get it once in a while when we talk about reverse mortgages from people who don't understand, but that is not the big thing. So luckily,
when they're used right, when they're used right, there's lots of benefit for the heirs.
Right.
There's lots of benefits for those kids if the parents are using them correctly.
Absolutely. I got a good friend of mine, Tom. He knows somebody. I didn't do this loan, by the way. $25 million paid for home on the ocean in an area called the Strand down in Orange County. Took out $4 million, which I guess is the limit now on these loans, to buy homes for 3 different children. I tried to look young and go in there as one of his younger sons, but it didn't work. But, there are a lot of different reasons to do this. Now the children have no payment. He's got no payment. And
everybody's happy.
My God, what's the worst that can happen? The parents can earn their wings tomorrow and fly away, and everybody's still taken care of.
Yeah, and those parents are getting to enjoy the benefit of watching what would have been their inheritance, right? Go to work today and help their kids today.
Even if you want to buy vacations with the money, because remember, your equity, in California anyway, your equity is probably coming back no matter what. But you can, just say it, buy memories with your children, and that your children will have with you. It's easy.
Yep.
Easier than people think. Look at insurance policies. We have only 1 minute.
Well, and then let me throw a couple of quick things in for you then. One is from a planning perspective, I love to see people enjoy their retirement and do things like that. But as long as they have made all the critical plans, like their own long-term care funding and things like that, if they've got all the I's dotted and T's crossed, then absolutely enjoy that stuff. The other thing I would say for folks with financial advisors is one of our webinars teaches them that there are some opportunities to make adjustments to the retirement plan, very beneficial adjustments, if you are moving or relocating through what's called a HECM for purchase, using a reverse mortgage for purchase. And they can make those changes at no additional cost because you're already doing a transaction, buying a house. Yes. And so that's another webinar you want your advisor on so they learn about those opportunities.
Sometimes if you have the money, you get a reverse mortgage, put a down payment, or buy your retirement home before prices go up too.
That's right.
But Phil, thank you so much